Investing can seem intimidating, especially if you're just starting out. But the truth is, anyone can learn to invest, and you don't need a lot of money to begin. In this video, we're breaking down the basics of investing, including where to start, what to know, and how to build a wealth-creating strategy from scratch. Whether you're saving for retirement, a major purchase, or just trying to grow your money, understanding investing is key to achieving financial success. 1. Why start investing? Investing allows you to grow your wealth over time using the power of compounding. Compounding is when the money you earn from investments starts earning money itself, creating a snowball effect. Here's a quick example. Imagine you invest $1,000 at a 7% annual return. In the first year, you'll earn $70, and in the second year, you'll earn 7% on $1,070, not just the original $1,000. Over time, your investment can grow significantly, even if you never add another dollar. By starting to invest early and letting your money grow, you can reach financial goals faster. And with many types of investments available, there is something for everyone, regardless of your budget or financial experience. 2. Key investing terms you should know before diving in. Let's cover some basic investing terms that you'll encounter. Stocks. Shares of a company that represent ownership. When you buy stocks, you're buying a small piece of that company. Stocks can increase or decrease in value depending on the company's performance and market conditions. Bonds. Loans you give to governments or corporations. In return, they pay you interest over time. Bonds are typically less risky than stocks but offer lower returns. Mutual funds. Investment funds managed by professionals that pool money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. ETFs. Exchange-traded funds. Similar to mutual funds, ETFs are funds that hold multiple stocks or bonds. Unlike mutual funds, they trade on stock exchanges like individual stocks. Dividend. A payment made by a company to its shareholders, usually from profits. Dividends can be a source of passive income. Portfolio. Your collection of investments including stocks, bonds, and other assets. Risk tolerance. The level of risk you're comfortable with. Knowing your risk tolerance helps you choose investments that align with your financial goals. Understanding these terms will help you navigate the investing world and make informed decisions. 3. Steps to start investing. If you're new to investing, here's a simple step-by-step process to get you started. 1. Set clear goals. What are you investing for? Your goals will shape your strategy. For example, if you're saving for retirement, you might have a different approach than if you're saving for a down payment on a house. 2. Assess your risk tolerance. Determine how much risk you're willing to take. Younger investors with a longer time horizon might be comfortable with higher risk, while older investors might prefer safer options. 3. Choose an investment account. To start investing, you'll need a brokerage account or retirement account like an IRA or 401k. Research your options and choose one that meets your needs. 4. Build a diverse portfolio. Diversification means spreading your money across different investments to reduce risk. Instead of putting all your money in one stock, consider a mix of stocks, bonds, and other assets. 5. Start small and increase gradually. You don't need a large sum to start. Many brokerages allow you to start with small amounts, and you can build your portfolio over time. 6. Reinvest dividends and earnings. Reinvesting allows you to compound your returns, increasing your wealth over time. Following these steps will help you lay a solid foundation for long-term investing success. 4. Different types of investments for beginners. There are many types of investments, and each one has its pros and cons. Here are a few common options. Stocks. Stocks offer the highest potential for growth but come with the most risk. They're a good option for long-term growth, especially if you're willing to ride out market ups and downs. Bonds. Bonds are more stable than stocks and provide regular interest payments. They're a safer choice for conservative investors or those nearing retirement. Mutual funds and ETFs. Both mutual funds and ETFs offer diversification by investing in a mix of assets. ETFs are typically more flexible because they can be traded like stocks. Real estate. Real estate investing can provide passive income through rental properties. However, it requires more capital and involvement than other investments. Certificates of deposit CDs. CDs are low-risk, fixed-term investments offered by banks. They're safe but offer lower returns than stocks or real estate. Each type of investment can play a role in your portfolio, depending on your goals and risk tolerance. 5. The power of diversification. Diversification is a key strategy for reducing risk in your portfolio. By holding a variety of assets, you're less affected by a single investment's performance. Here are some tips on diversifying effectively. Spread across different asset classes. Include a mix of stocks, bonds, real estate, and other assets to balance risk. Invest in different sectors. Instead of concentrating on one industry, consider sectors like technology, healthcare, and energy to further diversify. Consider international investments. Investing in global markets can reduce reliance on your local economy, increasing your portfolio's resilience. Use index funds and ETFs. Index funds and ETFs provide broad exposure to the market and are an easy way to diversify without needing extensive research. A diversified portfolio is more likely to weather economic downturns and continue growing over time. 6. Long-term vs. short-term investing. Investing can be categorized as long-term or short-term, each with its unique advantages. Long-term investing. This approach involves holding investments for years or decades, allowing your wealth to grow and compound over time. Long-term investors focus on growth and are less affected by short-term market fluctuations. Short-term investing. Short-term investors aim to make quick profits, often through trading stocks or other assets. This strategy can be riskier, as it depends on timing the market. Most beginners benefit from long-term investing, as it reduces stress and minimizes the impact of temporary market dips. 7. Avoiding common investment mistakes. Here are some common mistakes new investors make and how to avoid them. Emotional decision-making. Reacting to market swings can lead to poor decisions. It's essential to stay calm and stick to your plan. Timing the market. Trying to predict the market's movements is challenging even for professionals. Instead, focus on consistent investing and ignore short-term noise. Lack of research. Investing in unfamiliar companies or assets can lead to losses. Always research before investing. Neglecting fees. Many investment accounts come with fees, which can eat into your returns over time. Look for low-cost options and be mindful of trading fees. Avoiding these pitfalls can help you build a more stable and successful investment journey. 8. Monitoring and adjusting your portfolio. Your financial situation and goals can change over time, so it's essential to monitor and adjust your portfolio as needed. Set regular check-ins. Review your portfolio quarterly or annually to see if it's aligned with your goals. Rebalance as needed. If one asset grows significantly, it can unbalance your portfolio. Rebalancing involves selling some of the higher-performing assets and investing in underperforming ones to maintain diversification. Stay informed. Keep up with financial news, especially about industries you're invested in, to make informed decisions. Monitoring and adjusting ensures your portfolio stays aligned with your goals, helping you navigate changes in the market or your personal life. 9. Resources to continue learning. Investing is a continuous learning process. Here are some resources to expand your knowledge. Books. Titles like The Intelligent Investor by Benjamin Graham and A Random Walk Down Wall Street by Burton Malkiel provide excellent insights. Podcasts. Shows like We Study Billionaires and the Investopedia Express offer valuable tips and trends. Online courses. Platforms like Coursera and Udemy provide in-depth courses on investing, often taught by professionals. Financial news websites. Sites like Bloomberg, MarketWatch, and Yahoo Finance are great for staying updated on market trends. The more you learn, the better prepared you'll be to make informed investment decisions. 10. Final thoughts. Investing for a strong financial future. Investing may feel overwhelming, but it's one of the best ways to secure a financially stable future. By starting small, diversifying, and sticking to a long-term plan, you can grow your wealth over time and achieve your financial goals. Remember, every investor was once a beginner. Take it step by step, keep learning, and enjoy the journey to financial freedom.